welcome to our latest Insider interview. In the studio, I have with me Duncan MacInnes, fund manager of the Ruffer Investment Company. Duncan, thanks for coming in today.
Thanks for having me again.
So Duncan, Ruffer Investment Company, it's one of a small number of wealth preservation strategies. Could you explain your investment approach and which types of investments you back?
Yeah, so Ruffer's been going for 30 years and we've always done one thing. The one thing is a global, multi-asset, absolute return, go anywhere strategy, totally unbenchmarked. And that means we start with a blank sheet of paper. And what we try to do is find a mix of protection and growth assets in the portfolio that hopefully when you put them together, provide some capital growth, but also that preservation of wealth that you talked about. Now, the growth assets are usually equities, sometimes commodities, but usually listed equities. The protection assets, that can change quite dramatically really based on the economic environment or the market environment. So it's often bonds, currencies, precious metals like gold, but also sometimes it's derivatives, a small part of the portfolio that can punch very hard in certain circumstances to protect against specific risks that we see.
In a rising market, your shareholders wouldn't necessarily expect you to keep pace with, say, how the global stock market performs. However, over the past 3 years, it has been a difficult period of performance. Over that period, you've made a loss in share price total return terms. Why has that happened, and why should investors continue to back your strategy?
I would disaggregate a little bit, and you see in share price terms. So from its peak in 2022, the share price has moved from a premium of 4% to NAV to a discount today of 4%. So that swing in the premium to discount has cost about 8%, which is painful, especially in a wealth preservation vehicle. Now, the board of Ruffer Investment Company have been quite proactive in terms of trying to address that discount. We've got an industry-leading discount management policy. They've bought back 14% of the shares outstanding in 2024. That run rate is continuing into 2025. There's lots of discussions with shareholders about what more can be done about that. So that's the premium discount swing. Then the NAV performance on top of that, as you say, has not been particularly good. And that's because effectively we didn't have enough risk in the portfolio in 2023. We thought the market pain of 2022 would translate into a recession in 2023, and we weren't alone in thinking that, but everyone was wrong. Actually, the economy surprised positively and was good, and markets were good. So I think that's the biggest issue was 2023. 2024 was not great. It was flat in NAV terms, and then 2025 so far year to date we're up about 2 and a bit %. But I think when it comes to asking people to persist with us, I would say that we have been doing this a long time. We've done it through multiple cycles, multiple different market environments, and I would ask people to judge us over the full track record of Ruffer and Ruffer Investment Company. So that's 30 years annualized at about 8% per annum after fees, rather than judging us just on the one half cycle that we've seen from the end of 2022 through to today. It's very uncomfortable. We feel it too. But when the market weather changes, we think we're positioned to do very well, and we would ask for a little bit more patience.
You mentioned the low amount of exposure to equities has held back returns, but I think this is something you're seeking to address at the moment, as you have been increasing exposure to equities. Yes,
so the equity exposure got as low as about 12 to 13% in 2023, around the time of Silicon Valley Bank, where we were very worried about the financial system, asset prices, and a recession. Fast forward to today, the equity weighting is more like 30%, which is much more normal, in keeping with a low risk multi-asset portfolio. And so we've been adding that risk as that recession risk dissipates, but we've also been adding to bonds as well. So the overall portfolio is much more balanced, I think, than it was for that brief few months in 2023 where we were max defensive.
And within that equity allocation, you've been increasing exposure to China. Could you explain why?
So China is a controversial one. In the annual report, I referred to the portfolio as a portfolio of ugly ducklings, assets that nobody wanted to own. And I think maybe China is one of the ugliest ducklings. Now, why do we own China? Let's start with the valuations. So China is one of the cheapest equity markets in the world. You're looking at 10 times earnings for the index, even global technology leaders like Alibaba on 12 times. Sentiment to Chinese equities and the allocations that people have to Chinese equities are very, very low. The word that we most commonly encounter when we say that we have exposure to China is that it's uninvestable. And I get it. I get why people would say that they think it's uninvestable, but I think uninvestable should be music to your ears. It's a very closed-minded approach. It suggests that there is no price at which they would be willing to take that risk, and I think that's not the right way of looking at it. So maybe the next way of looking at it is China's 25% roughly of global GDP. We all have exposure to the Chinese economy, whether we like it or not. If you own global growth companies like Caterpillar or LVMH or Starbucks or Tesla or Nvidia, you have China exposure. You're just paying a much, much higher price for it than owning the risk directly. And then maybe the last element, which I think is quite an important example of how we think about all assets. We think about them individually, but we also think about them in the portfolio context. So in the portfolio context, what are people most worried about with China? They're worried about the continuation of Cold War II, that Xi invades Taiwan. Some really bad outcomes could happen and Chinese equities could have a huge loss. That is possible. But in that scenario, if we go down that path, that's extremely negative for the global economy and it's extremely negative for global markets. And in that world, I think the rest of our portfolio does very well. So we have gold, we have oil, they'll do well. The unconventional protective assets, the downside equity protection, the downside on credit protection, all these assets should do very well in that world. So in that really bad scenario for China, I think the whole portfolio is well set. On the other hand, what if Trump and Xi do a deal? He's a man that loves to do deals. He's talked about having a productive phone call. It's possible that China gets brought in from the cold, welcomed back into the global economic forum, and Western investors have to re-engage with the market, which would be very positive, we think, and could result in a significant re-rating.
You mentioned you've been increasing exposure to bonds. Could you explain which types of bonds you back?
There's a lot to say on bonds. So I think if you step back a little bit, strategically or structurally, we think that bonds are probably in a bear market, and you don't want to have them as a part of your strategic asset allocation, or certainly not as much of them as you might have in the past. You've now had 4 consecutive years of losses on US Treasuries, which has never happened before. Back in 2021, I was writing articles about the death of the 60-40 and no, Mr. Bond, I expect you to die. And so the situation has changed quite a bit after those negative returns. Why do people own bonds? They own bonds for income, they own them for protection, and they own them for diversification. And if you go through that checklist today, then the income has got much better. Rates have gone from 0 to 4 to 5. The protection, I think, is back on the table. If something bad happens in markets, if you have a recession, then there's room for the Fed to cut interest rates, and the bonds should do quite well. But where I think bonds still struggle, maybe even fail, is on that diversification element. So there's lots of academic research out there that suggests that when inflation is above 3, stocks and bonds are positively correlated. They move in the same direction. This is exactly what we saw in 2022, which was a disaster for diversification. And so it's not clear that bonds are going to be that useful. However, tactically, we think that bonds could be interesting, especially from a few weeks ago when we were buying. The bond yields backed up real yields, so inflation-linked bonds got up to 2.3 in the US, and we were buying there, because what you're getting when you buy a 10-year inflation-linked bond is a promise from the US government to pay you 2.3 plus inflation, whatever inflation turns out to be, for the next decade. And I think that becomes quite an attractive investment because firstly, you can just hold it to maturity and you know you're going to get that minimum base level return, or inflation can spike or bond yields can come down. Those bonds can rally in price, which is what they've been doing in the last week or so. And then you can maybe sell them for significant short-term profit and reinvest into something else. So we look at all sorts of bonds, nominal bonds, inflation-linked bonds, US, UK, all around the world. But the recent purchases have been US tips.
And how does your bond exposure reflect your latest views on interest rates and where inflation is heading?
The market has moved a long way on pricing interest rates. About 6 months ago, the forecast of the bond market was, I think, 8 cuts in 2025 from the Fed, probably around that for the Bank of England. And then we moved to a point a few weeks ago where there were almost no cuts, maybe 1 or 2 cuts priced in for the year, and that was when we were buying. We're back to sort of similar 2-3 cuts priced in, and I wouldn't quibble with that too much. That feels about right, barring unforeseen events. What I think is really interesting is what's going to happen with inflation. So we have now had 4 years, 48 months of above target inflation in the US. And yet, despite that, the Federal Reserve Chair, Jerome Powell, has come out and declared victory on the fight against inflation. And of course, they've started cutting rates in the US and in the UK and in Europe. So if you've had 4 years of above target inflation and you've already started cutting rates when it's above target, it would maybe suggest that the target isn't the target, or isn't at least the whole picture of what they are looking at. And if you zoom out a bit and you look at the big picture of inflationary episodes, like in the 40s or the 70s, what you see is this pattern that inflation comes in waves. So we've had the first wave of inflation. We've then had the disinflation, which we talked about the last time I was on. The question is there going to be a second wave? And we think there might be. And if you were to concoct a recipe for what would cause the second wave, I think it would look quite a bit like today's current setup. You've got an economy that's surprising everyone and being strong. You've got a full employment, strong wage growth, central banks who've declared victory on inflation, perhaps prematurely, interest rate cuts happening, governments that want to stimulate, still geopolitical risks, although we have to admit they're probably receding a little bit, and then also lower commodity prices. So it's a lot easier for inflation to accelerate from here when oil is in the 70s than when it's in the 90s or 100. So I just think that it's way too soon to declare victory on inflation. But when you look at market pricing and you look at what central bankers are saying, to some degree, they're saying it's yesterday's problem.
And your view that there could be a second wave of inflation, that is the reason why you think the 60-40 portfolio may not work as well in the future as it has done in the past?
That is one of our main views, big picture views, is that the 60-40 is not going to be sufficiently diversified because of those correlation characteristics that we talked about. And so people, investors, ourselves and people who might invest in us are going to have to be far more thoughtful in terms of their portfolio construction and a bit more nimble, because the truth is that asset class correlations, the way that the different assets move in relation to each other, is going to change quite significantly based on what point of the cycle you're going to be in, which is very different to the 20 years pre-COVID, where we basically existed in one fairly benign, low growth, low inflation economy.
Duncan, thanks for your time today.
Thanks.
So that's it for our latest Insider interview. Hope you've liked it. For more videos in the series, hit that subscribe button and do give us a like. And hopefully, I'll see you again next time.